Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we are going to be talking about trends. You have all heard me mention them in other videos and touch on what they basically are, but we will analyze them today in a bit more depth. I believe everyone getting into Forex has heard the trading expression, the trend is your friend. The reason why that phrase is so popular is because quite frankly it's true, and trend identification and analysis is key to a well-rounded trading plan. Forex trend lines can be quickly identified and are used in almost all charting analysis due to its usefulness and simplicity. Let's now discuss what trend lines are, how we can accurately draw them, and how to apply them when trading. As we already know, there is not any single standalone trading strategies that will give us a 100% win ratio. However, what we generally want to do as traders is improve our chances of making winning trades and identifying high probability trade setups. One of the most comprehensive is trend trading. Trend trading is a simple way to exemplify your existing strategy and reduce strategy imperfections by identifying the strongest trends in the market. When our entries are not necessarily the best, or when temporary shifts in the market occur due to factors such as news releases, our losing trades can always come good when trading the direction of the market's trend. As we can see here, we have a strong bearish downtrend. The market retraces here more than we may have expected. However, depending on where our stop loss was placed, this potentially losing trade was able to continue on and become profitable as we were on the side of probability. If we measure the amount of downward movements versus the amount of upward movements in any given bearish trend, the direction of the trend always prevails at yielding more pips in the movement. The same would be true if the trend were reversed. How to determine the trend? Determining the trend is seemingly obvious as we move to the larger timescales. When you look at a wider view of any given chart, you can ask yourself the question of which direction a price is generally moving in. As we can see here, that direction is up. If the trend is moving upward or bullish, then confirm the direction of the market by identifying a series of higher highs and higher lows in accordance with price action on the chart. A valid uptrend will almost always have these. Here we can see each successive high is higher than the previous high, as well as each new low is higher than the previous low. Now, all good things do come to an end, so eventually this trend will be broken. A good indication of the trend being broken and possibly reversing is when the uptrend starts to present a series of lower lows and lower highs. This will usually occur along the lines of prominent support or resistance. Identifying when a trend has come to an end is necessary in order to know when to exit your trades, in this instance if you are long, or even trade the reversal after identifying said reversal. This example of a trend reversal shows us how once a lower low was established, the trend continued on the opposite direction. If we were trading the reversal, we would seek to join the new trend when the market retraces to the next lower high. When we look to identify lows and highs, it's perfectly acceptable to point out the most obvious ones. It is advisory to do it on the daily or 4-hourly chart so that you may view the bigger picture and identify obvious direction. If the direction is not obvious, or your trend is approaching prominent support and resistance, move on to another pair and check back once things have become more clear. Using trend lines. Using our trend line tool, we are now going to draw in a guide along this trend line. It is often easiest to identify a trend by doing this. Trend lines make it clear for us to identify areas where the market is likely to bounce off our drawn support and resistance. We could couple this perhaps with another technical indicator such as the Fibonacci retracement tool to identify a potential bounce using the two converging indicators. Here we would have anticipated a bounce along this line after this higher high, and our Fibonacci level and the trend line meet up to offer us a potential high probability entry. The chart now shows us levels that prices respected in the past while moving upwards in the direction of the trend. We can now look for long entries in this instance into the market until eventually the uptrend comes to an end. Now please take some time to think about the ideas we have discussed today, how they apply to the Forex markets, and how you may apply them in future. Please sit back and contemplate what you have learned today, and remember, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.